Welcome everyone to the third quarter liquidity briefing hosted by Safened and the Carfang group. The title of this quarter's presentation is Yield Enhancement on Your Cash Deposits. I'm Tony Carfang with the Carfang group. We're consultants in the area of treasury, payments, and liquidity. Our co-host today is Graham Henderson, head of sales at Safened, the Global Liquidity Platform for banks and corporate treasurers. We're joined today by a panel of experts, Sid Bhandari, CEO of Deposit Book, Scott Walks, head of Global Liquidity Products at Morgan Stanley, and Dave Robertson, head of Treasury Solutions at PMC Treasury. Our agenda for today is very straightforward. I will begin by discussing the background and the environment for corporate cash and banking trends, laying the foundation for the search for yield and the challenges in this environment. Graham will talk about technology solutions in that search for yield, and in particular, Safened's Global Liquidity Platform. Sid will be doing a deep dive into the one part of the world where there are actually interesting yield opportunities on cash deposits at highly rated banks. I won't steal his thunder, so you have to wait for Graham's presentation or Sid's presentation. And then we're going to move into a panel. Scott and Dave will join us, bringing their real-world expertise to various topics in the area of liquidity and the financial markets. Now, a couple of housekeeping points. Feel free to ask questions during the course of the presentation. We have a lot of content, so we may not get to the questions, in which case we will answer them in writing to all of the attendees within a week of the webinar. We will also be sending out to everyone the recording link and a copy of the deck. So feel free to use that, pass that on to your friends, and get as much value out of it as you can. So again, thank you for joining us today on this third quarter liquidity briefing. And frankly, we hope to see you at our fourth quarter briefing next quarter. So let's move right into the content right now and into the current liquidity overview. And there are three things that we're going to talk about in this regard: the corporate cash trends, what's going on with banks and bank deposits, and then an interesting bead here on broker deposits, which we are beginning to see emerging as an institutional channel. So going into U.S. corporate cash, as you can see on the chart, corporate cash has skyrocketed, I believe on the next slide. Since the crisis last summer, when things shut down last March, corporate cash is up 33%, up to $4.1 trillion, a huge increase. Peaked at 4.1 trillion at the end of last June, and has since backed down to 3.7 trillion, which is still well above trend line. And if we look at the far right-hand chart, we have an interesting perspective here of U.S. corporate cash as a percentage of U.S. GDP. Obviously, it spiked, but I think the important news here is it had already been on a 3-decade-long upward trend from 6% of GDP back in the 1990s, and it's up at 17% right now. That's 3 times its historical average. And again, the long-term implications are things we might actually talk about a little later in the panel. Now, let's go to the next slide and dissect what's actually happening sort of under the hood, under that top line number. And the headline is really simple. Corporate use of bank deposits is way up. Corporate use of money market funds is way down. Corporate use of time deposits is flat. And then there are some other instruments on the periphery. Following the pandemic, corporations raised liquidity, and it's just sitting there in cash in bank deposits. They retreated from prime money market funds, and as a percentage of total liquidity, actually fell quite a bit. Money market funds as a percentage of corporate cash is at a 24-year low. Money market funds had kind of been the mainstay until the financial crisis of 2008, where they kind of fell and represented about a third of corporate cash. But now they've continued to fall. And again, it'll be interesting to see how that plays out. Now, let's move on to the bank side, because here are some really huge challenges that the bankers are facing. There's been a huge influx of deposits onto bank balance sheets. And the challenge for banks is, how do we handle them? What do we do with all these deposits? And for some banks, the question is, should we discourage customers from making more deposits or encourage them to take their deposits elsewhere, which is really sort of a sacrilege, right? I mean, you spend years and years and years building and nurturing relationships. The last thing you want to do is ask a client to take some of their business elsewhere. I think today, with the solutions that our panelists are going to be talking about, we believe you don't have to send your customers elsewhere. We believe that there are ways that you can actually handle this inflow either on your balance sheet or at least retain visibility. It's interesting to note on the right-hand side, again, as a percentage of GDP, U.S. bank deposits have been for a very long time flat at about 60%. Solid long-term average. Now it's jumped up to 75%. Will it stay there? Probably not. Will it come the whole ways back down? If it does, there are going to be some really interesting implications there, because we're talking now about $4 or $5 trillion of cash that could be flowing back if it falls from 75% of GDP down to 60%. Is that sustainable? Will things revert? We just don't know. Now, on the next slide, we have a couple of trends that I wanted to draw to your attention. And if you look at the upper right-hand side, year over year, non-interest-bearing deposits at U.S. banks have grown by 38%. Non-interest-bearing deposits have grown by 38%. Obviously, corporate treasurers have abandoned the search for yield. And today our panel is going to be talking about how you can rekindle that search for yield. On the bottom right, the other interesting tidbit there is uninsured deposits at banks have grown by 20%. So think about this for a second. The biggest growth has been in uninsured, non-interest-bearing deposits. You will not find that in any economics textbook. This is just unheard of. And that speaks to the challenge that both corporate treasurers and bankers are dealing with, and we will be discussing for the remainder of the morning. Now, let's move to one more point on broker deposits. We see this as really interesting and emerging as an institutional channel. Now historically, these had been FDIC insured deposits, where some agent was in the middle taking large deposits, breaking them into smaller deposits, and putting them out into hundreds of institutions. It's basically an insurance capture operation. But in fact, it has now shifted, and as the FDIC statistics show, there's a large segment of these broker deposits now that are uninsured deposits. These are institutional deposits, and if you look at the trend line in broker deposits, this is really uncanny. I mean, there's very little in finance that you can plot over a 10-year period and get an R-squared value of 0.97. I mean, this is a straight line moving upward. And what that tells us is that banks are using this as a deliberate part of their deposit gathering strategy. This is not a marginal deposit gathering channel. This is a deliberate channel. Otherwise, you would not see a line that looks like that. 1.1 trillion. I mean, if you think about this, banks are awash in deposits. discouraging some customers, yet still acquiring $1.1 trillion of deposits in this channel. We actually asked bankers in our State of the Commercial Deposit Survey that we do at the beginning of each year, and many said they believe that technology-sourced structured deposits is the wave of the future. And whether or not they need deposits now, what's more important is that they gain experience and climb the learning curve in managing this channel. So we think that this is very important and very interesting. So with that, let me segue in, to Graham, who will be talking about technology-sourced and structured deposit platforms.
Great. Thank you very much, Tony. And thank you all for joining us on this webinar today. We're very excited for what we're going to be able to cover and hope that you all take something away from this. As Tony mentioned, I'm Graham Henderson, Head of Sales for Safened. I'm based in New York. So this brings us to the solution side of the conversation. So how can we help corporate treasurers optimize their cash deposits while at the same time help our partner banks bring in the most attractive tenors and rates? For those that may not be familiar with us, Safened is a fintech firm offering a multi-bank deposit platform to corporate treasurers. Treasurers can access this platform directly or through an intermediary like Morgan Stanley Investment Management. One of our panelists today, Scott Wax, is representing Morgan Stanley there. So you may be asking, where do I fit in? So as a partner bank, you will be able to offer tenors and rates to assist with your balance sheet management. As a distribution agent, you will be able to offer your clients access to a network of highly rated global banks. You can offer our platform as a standalone or through APIs into your bank or client-facing portal. And then as a treasurer, you will have access to deposit products and rates from a lineup of well-known and maybe lesser-known global banks, but all very highly rated. And the best thing about this for the cost, there is no cost for the corporates, there is no cost for the distribution agents. Our partner banks will be charged when someone makes a deposit. So if we want to look at the process flow now, so on the right-hand side, we have our lineup of partner banks. Some partner banks input rates and tenors. These rates feed into the Safened platform. So it's also important to note that the partner banks completely control the products, tenors, and rates they want to show. These can be changed, added to, deleted, as the bank's appetite for deposit changes. So the corporate treasurer on the left-hand side checks the available products, makes decisions based on their corporate needs, and then executes through the platform. At the bottom there, our settlement broker-dealer, North Capital, then handles all the cash flow. KYC information is collected by Safened and shared with all the relevant parties. So again, multiple KYCs sent to different banks. We take care of all of that. We pass along all of that information and get the accounts all set up. So it's also interesting to note that our technology is not constrained by currency or product type. We can handle any other currency, not just the USD, GBP, euros, et cetera, et cetera. So, and the products that the banks want to offer at that point. So on the next slide, 3 different avenues here. So most basically for the partner banks, they can offer an optimal mix of rates and tenors to best manage the balance sheet. Simple, that's what the partner banks can sign up and get moving. Alternatively, or in addition, they can also, under fiduciary cash management, offer their clients access to third-party deposits rather than having to turn away those deposits. I think Tony mentioned, banks having to turn away deposits at this point, US banks being flush with cash. So what our platform allows is for partner banks the option of not having to turn away the client's deposits simply by directing them to the platform and multiple third-party banks. The banks can satisfy their customers' deposit needs, and most importantly, or more importantly, the banks will maintain visibility into where their clients' cash is moving, which deposit types are going into. And then, hopefully when this environment turns around, it'll be very useful. The bank will be able to bring those deposits back in-house. And the third point there, liquidity management, we've heard from some banks that utilize the platform as a means to offload their own excess liquidity also into these highly rated banks. So let's look now is how do depositors benefit? So the corporate treasurers will have access to the platform and all the conveniences included there. Setup is easy, research into the partner banks, their products and rates are all available through the platform. Reconciliation, reporting are also provided through the platform, really making this a true one-stop shopping experience. And I think those that are now more familiar with platforms, maybe in other product sets, et cetera, this is where the market is going. This is what's being offered. So, being able to go to one place to do everything is the direction of the future. Another interesting little benefit here that I'm not going to go through each one of these, but the ability for the treasurer to reverse query for rates and products they may not initially see. So, if there is a certain tenor that they're interested in, the bank may not be showing that, but the ability to submit that in there and hopefully get the bank to respond. So on the partner bank benefits, again, I'm not going to go through all of these. I've covered several of them already, and there are numerous of these. Reduction in all-in costs, outreach to clients they may not have been able to attract in the past, the diversification into other markets they typically are not in, and then many others there. So partner banks benefit as well. So screen here, Safened portal, this is what our clients will see. A few screenshots just to show you the experience. So we have a screen up here showing deposit positions, when the client has got deposits across several different banks, they can see that through the platform. Outstanding orders that are in the system that are being put through, and a lineup of the available banks and the products and the rates that they wish to show. So many other screens. This is just a snapshot of how it could look. Obviously, for APIing into a bank platform, this is all going to be logoed with the partner, logoed with the client, et cetera. So I'll quickly end up on the last slide here. So, in closing, it's been a busy last 6 months for Safened. We became a US registered broker dealer, opened a New York office to be closer to many of our potential banking partners and distribution agents. We've partnered with Deposit Book to offer a global array of banks and their deposit products, which we're very excited about. So on that note, I'm going to pass this over to Sid from Deposit Book, who's going to take a deeper dive and explain a little more about the region, about the banks out there. Thank you very much. And Sid, maybe now you're switching over to off mute.
Hi, thanks, Graham, and good morning, everyone. I'm Sid, CEO of Deposit Book, speaking from Dubai, so it's over 7 p.m. here, but really delighted to be part of this conversation, and also delighted for our partnership with Safened, where we can, US customers, corporate treasurers, and other institutional investors can actually access our partner bank rates across a diversified set of highly rated banks. So just to give you a brief background, we are a UK and a UAE based platform, which basically is driven by a vision where our customers can basically, our banks can use us as a digital funding channel, where they can reach out to customers across borders, look at corporate treasuries, institutional investors like pension funds, asset managers, and be able to seamlessly place deposits, manage deposits, negotiate deposit rates through a digital channel. From a corporate treasurer's perspective, clearly, as Graham had mentioned, there are several benefits, and I think the key benefits that we see as from a corporate treasurer perspective, and what we hear from our customers is that there's one single portal where they could manage their cash allocation centrally across multiple counterparties. They could also digitally onboard with those counterparties without going through onerous KYC and onboarding process, and also price discovery for them now to adhere to best execution policies and be able to give the best prices for their cash They can run element like reverse query, where banks, based on their requirements, can bid for their deposits competitively. So corporate treasurers benefit in a lot of ways. I'm here to talk more specifically about GCC banking sector. And one of the key elements of the GCC banking sector is their highly superior risk-adjusted returns. And that is something that you could see from some of the sample rates that we are showing across 1 to 12 months. So essentially, GCC is comprising 6 countries: Saudi Arabia, UAE, Kuwait, Qatar, Bahrain, and Oman. Most of these countries are high investment grade countries, which have over the last 10 years taken a very strong effort to go from their naturally oil and gas backed economy to a very strong economic diversification program led by government spending in infrastructure and many other projects. So in spite of the pandemic, you've seen that GCC banking sector has actually remained robust, and the $2 trillion dollar asset base has grown 8.2%, which is quite unprecedented if you really look at other developed market indications. There is a sustainable profit growth, and if you really compare the GCC banking sector with US and European peers, as you could see from the chart, it compares very favorably, both in terms of return on equity, their capital adequacy ratios, and return on assets. So essentially, what GCC banking provides is basically a high-rated environment under very highly regulated central bank and government, with a very strong interest rate offering. And I'll come to the reasons why they offer better rates than the normal banking channels, and be able to compete on many statistics with the US and European corporates. So just to give you a bit more overview on in our next slide on the banking sector. If you see that UAE and Qatar and Saudi Arabia are the 3 principal economies which dominate the banking sector. On our platform, we have some of the most highly rated banks who favorably compare to all the US and European banks in many statistics, including return on equity and return on assets. As you could see on the right-hand side, they're all high investment grade banks and are very active in terms of asset writing compared to the other global banks which are in the market. One of the key elements, which is you've seen that most of these banks are also very active in the EMTN market and the bond issuances, where they're actually even contemplating issuing ESG-linked bonds in spite of coming from countries which have been dependent on fossil fuels for a long time. So there's a lot of healthy trends that are currently happening within the banking sector. I will come to the reasons on why the banks in GCC are able to give much better than rates in dollars compared to other markets. So if you go to my next slide, you will see that a very, very peculiar statistics as far as the loan to deposits concerned within the GCC. So on the top side, you will see that the loan to deposit ratio for GCC banks is well over 90% compared to low 60% for US banks. Now that's a major difference, which means that their asset writing remains much stronger than their deposit mobilization. The reason for their slower deposit mobilization compared to their asset writing is purely because it's a very unique dynamic that most of these GCC countries have a low population base, of which a high percentage of its expatriate population. So their CASA deposits, which are the retail deposits, remain stagnant. And that's why they go to international markets and offer very high rates to wholesale or high value deposits to institutional customers globally. If you've seen over the last 4 to 5 years, there has been a very strong inflow from European institutional customers, which are typically the pension funds, asset managers, largely also multinational European corporates. and also European wealth managers and private banks who are allocating increasingly part of their cash allocation into GCC banks. To conclude, I will kind of give you a statistics in terms of their rating distribution. If you really look at from a rating distribution, majority of the banks in GCC remain above investment grade. So from a counterparty risk assessment, they completely comply with investment policies of many corporate treasurers that look to allocate assets. There's also a unique element where there is a government and central banks provide an implicit guarantee on deposits. So in spite of 2008 crisis or recent pandemic or even any other major economic actions, banks, government and central banks have always provided liquidity support to these GCC banks. So there has been no default of any bank within GCC since 1980s. You also see that the rate enhancement across the 6 countries have been very strong, and it continues to remain strong. We saw through our platform billions of dollars going to Qatari banks as they were giving very strong rates last year due to their 2022 Soccer World Cup. So there was a lot of investments into the infrastructure sector. The industry sector, the trends remain very strong. If you really look at S&P and Moody's, they all have stable ratings across most of the markets. So really, it's one of those opportunities where you get a better risk-adjusted returns and are in a position to allocate some part of your cash allocation into these high-yielding deposits. So I'll be very happy with to talk to you in more details with Graham and see how we can help you to mobilize your excess cash into GCC banks. Thank you.
Thank you, Sid. Well, that was fascinating, and I'm sure we have a lot more to talk about that. But let's bring in the rest of the panel now. Scott Walks and Dave Robertson will be joining us. And let's just have Scott and Dave take a few seconds to introduce themselves, and then we'll get into the discussion. So, Scott.
Hi, everyone. My name is Scott Wax. I am the Global Head of Product at Global Liquidity Solutions at Morgan Stanley. I'm responsible for the management, strategy, development, delivery, and marketing of our short-term investment products, our Global Liquidity product set. I've been in this role at Morgan Stanley for over 7 years, and I've been in the industry for over 30 years. Global Liquidity at Morgan Stanley encompasses a number of different products, money market funds, ultra short income funds, separate accounts, and also for our clients as we aim to provide them with a full suite of short-term investment solutions. We've also partnered, as Graham mentioned earlier, with Safened to be able to offer our clients the deposit products through the Safened platform. In aggregate, we manage over $360 billion in AUM, and we distribute our products to institutional clients, retail clients across the Americas, Europe, and Asia. And we're the number 4 global money market fund manager in the world.
Thank you, Dave.
Thanks, Tony. Dave Robertson, very glad to be here today. I'm with PMC Treasury, and PMC Treasury primarily works with financial sponsors such as private equity firms and their portfolio companies. And we have offices in Asia, Europe, and the Americas. So we do take a global perspective. And what I do in leading Treasury Solutions is I really help companies optimize their financial risk management, their liquidity and cash forecasting and cash investing, and then also their working capital management. And then I have peers on the risk management side that really help companies identify the right hedge strategy, how to place the hedges, and how to get good price execution and ongoing monitoring and management of their derivatives portfolio.
Great, thank you very much, guys. Let's get into this panel discussion now. I think, heard enough of us talking about ourselves and our products, et cetera. So let's get to some of the meat here. So we'll kick it off with yield. Scott, I'll direct this one to you. And then obviously, Dave, if you have any follow-up comments or want to add anything, please do. So on the yield, Scott, what are you hearing from the corporate treasurers? What are you seeing in the market about the search for yield in this environment?
Thanks, Grant. Well, certainly the yield environment is very tricky and very challenging. So when we talk to our corporate treasury clients, certainly one thing to always keep in mind is corporate treasury clients are a very conservative group. In my experience, I can't think of an instance where a corporate treasurer was fired because they didn't earn one additional basis point in yield on their cash investments. But I certainly can recall one or two cases where a corporate treasurer lost their job because they lost some of the principal of the cash pool that firm had. But earning next to nothing, which is the current environment that we're in, is certainly very painful for corporate treasurers. As we talk to corporate treasurers and they think about what the options are, right? There's certainly trade-offs between the types of vehicles and the types of products and the risk and yield potential across all of them. When we talk to clients, certainly, deposits, as Tony mentioned in his opening comments, right, a huge part of corporate treasury portfolios. Money market funds remain a very big part. Yes, to Tony's point, they've shrunk over the last 10 years on a percentage basis, but there's still a very material portion. And in aggregate, money market funds are actually at one of the highest points that they've ever been at 4.4 trillion in the market. Now, a lot of that is skewed towards government money market funds, right? About 3.9 billion is in government money market funds, and that's really, largely a result of the characteristics of government funds versus prime funds since the money market fund reform that was implemented in 2016. Now, clients who are looking for enhanced yield or incremental yield beyond what a money market fund or beyond what some deposits can offer have looked for some of their cash that they have on hand for not immediate liquidity needs, but longer term needs. Some of their strategic cash or more longer term operating cash have looked into things like ultra short income funds. There are a wide variety of ultra short income funds. Some are aggressive, some are conservative. Corporate treasury investors have tended to look at those that are really just a step beyond money market funds. And we see yields on some of those in the upper teens these days. So certainly a big bump up from what the yield might be on a government money market fund, which is about 3, or a prime money market fund, which is somewhere between the 5 and 6 basis points duration. So it's a challenge, but our clients that we talk to are really looking to segment their cash and maybe be slightly more aggressive, but still on the conservative side, the very conservative side of the options with some of their cash that they don't need in the next month or so.
And I would certainly agree with everything Scott is saying. Maybe just a couple of other observations. We do see a point where companies begin to look at dividends and capital buybacks or even acquisitions as means of deploying cash. And in Europe, where the rates are negative, we've even seen some very strange behavior. So the whole working capital concept has been flipped, and you see companies making prepayments just to get cash off their balance sheet. And we question this because in essence, they're taking on credit risk, but they're not really thinking of it that way because it's a supplier for them. So, you have to be careful as you start to look at some of these alternative approaches. And then, I think we've also seen some of the companies where they know they've got the cash for a bit of a horizon. They begin to look at things, alternative vehicles, and that might even include like a supply chain finance program. But certainly, there's also a bit of an attitude where I have a limited amount of time to spend on things, and given the friction of actively managing cash and given the yield I have on it, we do see a lot of just inertia for many companies.
Dave, I'd like to follow up on that and go into a little bit of an opaque area that has long been, a challenge, and that is figuring out these earnings credit rates that banks offer or provide their customers to offset service charges. There's a nominal amount, and then there's like what's really happening behind the curtain. And you always have a lot of insight on that. Could you share some of that?
I feel like I fed you that question, Tony, because this is an area that I really love. To me, it's funny because when you talk about negative interest rates, people instantly think of Switzerland or Europe or Japan. They don't think of the US. But in fact, at PMC, we estimate that about 20% of US companies are receiving a negative interest rate on their cash. And many of them, if you told them that, they'd be shocked. But one of the things we do is we do price optimization work. So companies are feeding us their bank billing statements, which has not just the service fees, but it also has the earnings credit rate. And if you take that earnings credit rate and you subtract out the deposit administration fee, for about 1 in 5 companies, it's negative. So, the deposit administration fee is typically around 15 basis points. If your bank is giving you a 10 basis point earnings credit rate, you're paying your bank 5 basis points just to keep the cash in the bank. And so I think, talk about opacity, Tony, you've worked in this area too. These bank billing statements are incredible. They show your yield on the earnings credit rate, but in the service charges is the deposit administration fee, and you've got to put the two together. So having done that, I encourage companies to look at their net effective yield. And I think, to the point Scott was raising, even if you were to move that money out of ECR into a prime or government money market fund, you'd be decreasing the risk on the balances over 250,000 that are uninsured. And you'd also be improving your yield by getting it out of a negative carry instrument in the case of ECR, where the deposit administration fee is higher.
Great, thank you, Dave. Thank you, Scott, for that. So let's turn now to money fund regulation. And Scott, I'll direct this to you. So for the past 25 years, money funds have been an efficient and still are an efficient short-term investment option for treasurers. But in the current environment with a low interest rate, new regulations, that's changing that model a little bit. Can you comment on the outlook? I know you did speak a little bit about it when we were talking about the yield, but comment on outlook for the role of money funds in a liquidity portfolio going forward?
Yeah, absolutely. Yeah, thanks, Graham. So money market funds, I believe, will continue to have a tremendously important role in corporate treasury short-term cash portfolios. You think about some of the key characteristics of money market funds. Two of the most important ones are they offer socialized liquidity and diversification. So I think those are two things that are very important, and that goes in concert with the safety, right, the protection of principal and a reasonable yield. We've seen a number of changes to money market fund regulations over the course of the past dozen or so years. Since the financial crisis of 2008, we've seen 2 rounds of money market fund reforms, and we're in the midst of a likely 3rd round right now. The first round, which was implemented in 2010, really codified some of the structure around the liquidity requirements for money market funds. The second round, which was rolled out in 2014 but became effective in October of 2016, put in place a lot more information around disclosure, but most importantly, changed the fundamental construct of prime funds, institutional prime funds, and institutional municipal funds, and imposed a regime around fees and gates, with the considerations of fees and gates when certain criteria was met, most importantly, weekly liquidity falling below 30%. And that last element that I mentioned was, in fact, in my belief, in our belief, one of the unintended consequences of that was seeing money pretty quickly flow out of prime money market funds in March of 2020, when we had not the same type of credit crisis that we had in 2008, but a liquidity crisis, which is very different than a credit crisis fundamentally. But as money moved out of prime money market funds, we saw the acceleration of that process until the Fed stepped in with certain programs that helped to stabilize the market. So today, we've seen the President's Working Group roll out a proposal for money market fund reforms. A number of the items they're suggesting are some of the things that were looked at in 2014 and thrown off to the side. I think from a category standpoint, there are adjustments to the fees and gates regime, changes to liquidity management thresholds, things like that. I think are very likely to be where the regulators go with this next round of reforms. some of the other capital related reforms that they've tossed out there, capital buffer requirements, new requirements around sponsor support, liquidity exchange banks. I think those were non-starters before. I think they'll be non-starters again. And some of the other things that they've thrown out of there could be under consideration too. So, floating the NAVs for all prime and tax exempt money market funds, not just institutional prime and tax exempt funds, might be something that's out there as well. So, so I do expect that, that we will see further changes to the regulations around money market funds. But again, even with the changes that we experienced and the rather dramatic ones in 2016 that impacted prime money market funds, all we saw was money move into government money market funds, right? So the yield was a little bit less, but the risk was also a little bit less too. So that plays nicely with what the corporate treasurer wants. So over the long term, regardless of what the changes are that the regulators make in this next round, I do think money market funds will continue to play a very, very important role for corporate treasurers in the short-term cash portfolio.
And the only thing I would add is, obviously if rates were to increase, prime funds would become more attractive. But right now, where we're seeing the interest is in the government funds. The stats show that. Scott mentioned it as well. And I think that's both where companies are worried about counterparty risk, but it's also in some cases there's structures where the money has to be insured or under a certain set of parameters for legislative or regulatory reasons. And the government funds are a very efficient way of doing that, typically a better yield and than putting it in some kind of deposit that the bank insures on their behalf.
Thanks, Dave. Now, you're working with a lot of treasuries inside of your portfolio companies. Could you tell us a little bit about treasury automation trends and how treasurers and financial officers are using automation to enhance their search for yield?
Yeah, absolutely. So treasury automation is a huge area that we work in, and it really today it means much more than just a treasury management system. Because I think if you're a treasurer, the treasury management system often comes toward the end of the process. So if the data is in the bank or the data is somewhere in the company and you can't pull it out, whether that is payments data or actually forecast critical inputs, you've got to get that first. So really as a result of that, we're seeing a lot of requests for companies needing help in just consolidating and normalizing the data just to get the foundation right. And then we're seeing a lot of interest in constructing an efficient and accurate cash forecast. Typically, it's one or the other. You either have an accurate cash forecast that is just an absolute bear to maintain, or it's an efficient forecast, but nobody trusts it. And I think as well, the forecast, it's more than just a point estimate, right? It's a probabilistic outcome. So being able to convey the range of variance that could occur is critical when you're thinking about structuring a cash investment portfolio. So, the other thing I think is intriguing about the Safened product and what I've heard about it is just removing the friction, because when companies do want to invest, they're sort of trapped captively at their bank or what their bank will allow them to do. But if they can move to a more flexible model where they can access platforms that make it easier to get a broader array of options to move the funds at lower cost more quickly and get them back, that is something very critical to treasurers that are looking to invest their cash more actively.
And that's a fantastic point. And maybe let's just pass it to Sid for a closing comment before we summarize. What you're really talking about is best execution.
Mm-hmm. Yes.
And Sid, I know that's a hot button of yours.
No, absolutely. And that's what we experience with European counterparties, where MiFID II guidelines clearly ask them to look at best execution policies. As far as the deposits was concerned, you saw that a lot of corporate treasurers were looking at their relationship banks and looking to deposit most of the monies with their existing relationship banks. But through platform like ours, they can actually run a reverse request for quotation where, depending on the requirements, several banks, relationship banks or outside relationship banks can actively bid for their deposit rates, and they can discover the best risk-adjusted price as far as the best execution policy. So that's one of the key use cases from a corporate treasurer's perspective to use platforms such as ours.
Thank you.
Great, thank you, Tony. Thank you, panelists. I think we are up against time here, so I will have a couple of quick comments here at the end. And so first of all, I'd just like to thank fellow presenters, Sid and Tony. Special thanks to our panelists, Scott and Dave. And thank you all for registering, for signing into this and hearing what we have to say today. All attendees will be receiving a link to the recording of this webinar. So those that were unable to attend will be able to watch and listen at their convenience. Contact information is right there. Please feel free to reach out to me, reach out to any of our panelists. You know, I can direct traffic to the other panelists with any questions, any follow-up. And finally, I'd like to take this opportunity to invite you to our next quarterly liquidity webinar. That's going to take place on Thursday, October 21st. So details will follow about that. So thank you very much, everyone.